If you're finally tired of working at your 9-to-5 job and want to make money with trading, you came to the right video. In this video, I'm going to explain to you step by step how I went into Forex trading and show you how I managed to become a professional day trader step by step. I've been trading over 1.5 years now and I became profitable in the first half year. And I'm going to show you step-by-step tutorial how to get into Forex trading, how you place your trades, and how you make money with day trading. So you maybe be able to quit your 9-to-5 job in the future. This is sadly a skill that you can't learn overnight. But if you follow the right tutorial and follow my steps in this video, you have all the necessary tools to become a professional, profitable day trader and make a few $100 a day or maybe a few $1,000 a week. That's completely up to you on how much time you want to invest in learning this new skill. When I started out day trading, I wish I had a mentor who explained every detail to me how to get in day trading step by step. And today I'm going to show you exactly what is day trading, what is the Forex market, what platforms you need to know and how to use them, what strategy you should use as a beginner in day trading, and the strategy that made me my first few $100 in trading. So stay till the end if you finally want to make money with day trading and leave your 9-to-5 job. Because at the end of this video, you have every tool in your toolbox that you need to become profitable as a day trader and make a living of it. And after I showed you what you need to know about trading, I'm going to go over exactly where you have to place your trades and on which website you should start out trading so you can make money. And the best thing about that is you don't have to have a lot of capital. A few $100 or even just $50 or $100 would be enough for you to start out trading and make hundreds of bucks a day. So stay tuned till the end of the video if you want to know everything that you need to know to start out day trading and make your first few $100. So by the end of this video, you should have a clear path on how to become profitable as a trader, make your first money, and generate active and passive income daily. So first and foremost, when you start out in day trading, you're not going to win every trade you take. There's gonna be wins and there's gonna be losses, but that's where risk management comes in. Let me show you an example what I mean about that. If you have a risk to reward ratio of 3, and I'm going to show you later on what that is, it means that even if you have a 50% win rate on trades, which means of 10 trades, you win 5 and you lose 5, you still become profitable. How does that work? Let me show you. If you have a risk to reward ratio of 3, which means if you put $100 in a trade, if you win that trade, you're winning $300. If you lose that trade, you're losing your $100. And if you then combine these 5 wins with 5 losses, you lost $500 in total, but made $1,500 in total, which means in total you made around $1,000, even if your win rate was only 50%. That's why you don't have to win every trade. You have to be in a good mindset to be profitable as a trader in the long run. And don't become frustrated if you're losing maybe a few trades in a row. In the long run, it is always going to be profitable and you're always going to make money if you just follow the right steps. So before we start out, I'm going to explain you what exactly are you trading. In this video, I'm going to explain to you how you can trade in the Forex market. What exactly is the Forex market? Forex market is a short term for foreign exchange, which basically means you're trading currencies against each other. For example, like the euro to the US dollar. And in the Forex market, you're always trading currencies against each other. If you ever have seen the euro/US dollar, that basically means how much the euro is worth in comparison to the US dollar. And when you're trading this currency pair, you're not buying anything physical. You're speculating on movement in the market. It's like watching a boxing match between those currencies and placing a smart bet on who is probably going to win. Like betting on the euro that the euro is going to be more worth in the future than the US dollar. So you're not just clicking buttons or buying real physical currencies, you're trading real economic power shifts from those two currencies and how much value they have against each other. Let me make this simple for you. Did you ever went to a vacation and wanted to exchange your currency like the US dollar against another currency? Congratulations, you basically already exchanged a currency pair and traded into the Forex market. Let me give you a simple example for you. Currently, if you want to exchange 1 euro to US dollars, you are getting 1.11 US dollars per euro that you are exchanging. And this value can fluctuate in between months, hours, minutes, or even seconds. And these fluctuations between those currencies is basically the Forex market. You're betting on which currency is going to be, or probably going to be, worth more in the future than the other currency. And you don't really have to have a lot of information or knowledge about currencies or the economic difference between those countries or currencies. You just have to look at a chart pattern and place your trade in the direction that the currency pair is probably going to evaluate. Now, probably some of you are thinking, why not just trade stocks? I mean, it's basically called the stock market now. Here's why Forex is probably better for you as a beginner in day trading. It has lower fees if you want to place a trade in the foreign exchange market. You can basically place a trade 24 hours a day, 5 days a week. And 3, there is way more liquidity in this market, which means more people are willing to trade this currency, which means more people are willing to place a trade in this foreign exchange market than maybe other markets. Think of stocks like cruise ships. They're slow, expensive, and they are only running during the day. On the other hand, Forex is like a jet ski. It's fast, agile, and you can trade it almost all the time. And if you're now thinking, hey Sammy, I don't really have much money to work with, how can I start trading with maybe $10, $50, $100? This is really no problem for you. You don't need a bunch of cash if you want to start out trading. You just have to have the right strategy in mind and execute it nearly perfectly. But for the first months, when you start out learning how to trade, you shouldn't trade with your real money, because in the first months you're probably not executing your strategy perfectly, so there might be a high chance that you are losing all your money, maybe all of the $100 you started out with. So the first big disclaimer is, when you start out trading, use a demo account. You can make a demo account on every broker app and trade with virtual money. You don't have to use your real money. Yes, you're not going to win real money also, but you're not going to lose everything that you saved up and maybe want to spend in the Forex exchange market. And after the first maybe 1 or 2 months, you learned your strategy. You learned how it works, how the market is moving, and you get a whole lot of practice, and eventually you'll get the feeling how the market is probably going to move. And when you can finally say to yourself, all right, I'm ready for it. I became a profitable trader over the last 2 months. That's where you can take the next step. And the next step could potentially be a prop firm challenge. A prop firm challenge is essentially a challenge where you can sign up for a few dollars, maybe a few $100. And if you prove your strategy right, you're going to have an account with maybe tens of thousands of dollars that you can trade every day and make real money. And this is without even risking a single dollar of your own. I mean, you bought the challenge, yeah, but that may be just $100 and you could potentially make a few $1,000 in a week. And even if you lose this account, you can start a new challenge, but you didn't have to pay with your own hard-earned money that you saved up over the months or over the years. So you're just losing the money of the prop firms, not your real money. And if you win, you're winning real money. It's that simple. So now let's go over the tools that you need to start day trading and start using your demo account or trade real money. The first tool that we are using is TradingView. TradingView is essentially a platform where you can watch real-time indices, stocks, crypto, or foreign exchange. Let me walk you through it. First, click the link in the description below and TradingView is going to open in your browser tab. This is the starting page where you land. After that, you want to get started with TradingView, so you have to sign up with an account. And there is no problem, there is no sign-up fee. You can get the professional or essential or plus or premium subscription, but sign up for TradingView for the basic version is completely free. And after that, you're probably watching this website. So I'm trading Forex, which with this strategy you should too, but you can trade this strategy that I'm going to show you later in this video on every stock market that you like. But personally, for me, I'm trading Forex. So now let's click on the search button and search for the Forex exchange pair that we want to trade. For me personally and for my trading career, I use the GBP-JPY currency exchange pair, which means this is the currency exchange between the British pound and the Japanese yen. So search for it in the search bar, GBP, JPY, click on it, launch chart, and you're already in TradingView and are viewing the chart. And as you can see, the stock market is moving live. It is going up and down. The currency exchange pair is going up and down, and that's what you want to trade later. So for the overview of TradingView, there are a few essentials that you need to know. First, you have different time zones for the candles that you're watching. So in this example, I have a 5-minute time frame. So every candle represents the move of the stock market in these 5 minutes. So for here, you can see on the bottom, it says 11:05. So this candle was traded from 11:05 to 11:10. You can also watch other time frames, for example, the 1 hour or the 4 hour time frame. And these candles are obviously going to be a lot bigger because these candles were traded, for example, from the hour 9 to 10. That is the value that changed of these currencies between 9 and 10 o'clock in 1 hour. So here are basically a few things that you need to know about this chart. Later in this strategy, we're going to use a strategy where you watch the 1 hour time frame and watch for confirmation in the 5-minute time frame. And we don't really need indicators that TradingView is giving us. You can search for a few indicators, maybe order blocks, Bollinger Bands, EMA, that kind of stuff, if you know that thing. But you don't have to use indicators with my strategy. You just have to look at real-time charts, draw your lines that I'm going to explain you later in this video, and you should be good to go. So the next tool I'm going to give you is MetaTrader 5. If you ever watched other trading YouTube channels, most of them probably traded with the broker MetaTrader 5. For this program, also click the link in the description and it shows you this website. After you find yourself on the website, just click download MetaTrader 5 for Windows or for Mac OS or Linux or whatever you're using, and install MetaTrader 5. Fill in your name, birthday, email, mobile, and you got a new account. Just make sure you're remembering your user account and your password. After that, you should select your currency pair that you want to trade on. Now, after you landed on the MetaTrader platform or the program, you're going to select symbols, show symbols list, if you want to trade the GBP, JPY like I am. So, show symbols list. After that, you type in GBP, JPY. Click on it, show symbol, then OK. And after that, you have it in your market watch. So now let's open up a new chart window. So now we are on the 1 hour time frame on GBP, JPY. Yeah, this looks a lot different than TradingView. But don't worry, we're making our whole analysis with TradingView, and it is a lot simpler on TradingView. On MetaTrader, we are only going to place our trades. So if you have the GBP JPY chart open, you're gonna click on Show Trade Panel. So this is the trade panel where you can sell or buy this currency pair instantly. And you can give in the lot size if you want to sell 0.01 or you want to buy or sell 1 GBP, 1 British pound, which is currently worth around 169 yen. So this is the point where you are placing your trades. And if you make the demo account, you can practically start trading now. I can put in a lot size of 1 and think maybe the trade is going to go down. That could possibly very well be. So I'm just selling my position, accept these terms. Right, I'm in a selling position right now. And if you open your box right under here, click on trade, you can see I have a balance of 100,000 euros and we're currently in a trade. We are down $1, $10, but that doesn't matter. It's a demo account. I just want to show you how you can instantly buy or sell a stock so that you make your analysis on TradingView and put in your trades from your demo account with MetaTrader. Now I'm gonna leave the trade because that was just an example. And if we go to history, we can see we made one trade and how much profit we have made. It's minus $10, but it's only a demo account. I just want to make an example. And that's literally it. I mean, you just have to use TradingView in the right way. You have to use MetaTrader, and that's all you need for making your analysis and going to buy or sell stocks in the market. Obviously, if you want to be profitable and make it clear that you are profitable as a trader, you have to journal your trades, but more on that later. So first, if you want to get into trading and really don't know anything about the market, about trading, about foreign exchange, I'm going to show you the basics step by step. If you already know the basics, you can skip this part. So let's start with the complete basics. Candles and candlesticks. If you open up a chart, you will see these weird candlesticks that are forming up and down and the market is moving. But what does that mean? It means a candle represents market moving in a specific time interval. When you are on TradingView and you're setting your time interval of your candles to 1 hour, that means that the price movement in the market in this currency pair is represented by one candle. A candle looks like this. There is a body of the candle, there is a high, and there is a low. That is the highest point of the body of the candle, and there is the lowest point of the body. There's the highest point of so-called wicks on the candle, and there is the lowest point of so-called wicks on the candle. There are two types of candles that you have to know about. There is a positive candle and a negative candle. What is the difference between them? A positive candle starts with the price when the next full hour is starting. The starting point of the price from this candle is at the lowest point of the body of a green candle. On the other hand, if it is a negative candle, a bearish candle, that means that the opening price of this candle for this full hour, for example 11 p.m., is at the top of the body of the candle. The body of the candle represents where price was at the start of a new full hour. For a bullish candle, for example, that means the price started here at the bottom of the candle, and after that full hour the price was at this point. After that, a new candle is forming. The same goes for bearish or negative or red candles. That means the opening price of this candle at a new full hour was at the top of this candle. And after 1 hour passed, the closing price of this candle was at the bottom of the body of the candle. After that, a new candle is forming. So what are these weird lines above and below these candles? These are so-called wicks. A wick represents price movement within this 1 hour. Let me make it simple. In this 1 hour, the price was at the top of the wick at some point and was at the bottom of this wick at some point. But the price traced back to the closing position of the body. That basically means in this 1 hour, people push the price up on this bullish candle. So that means the price at one point was around here. And some people push the price of the market of this currency pair below the opening price of this candle, which means at some point the price of the currency pair was here. But in the end, this candle was bullish, which means the closing price was higher than the opening price. For example, at the start of a full hour, the euro was worth $5, for example. And after that full hour, after a bullish candle close, the euro was worth $6. Same for the negative example. If a bearish candle formed and the price of the euro against the US dollar was $5 at the beginning, it may be, for example, be worth $4 at the end of this candle. So in the end, basically, candles represent price movement in the market, and you can watch them so you know where the market is going to go, if the market is going up or down. If a lot of green candles or if a lot of bullish candles are forming, that means we are in an uptrend. An uptrend is basically where the price started at a low point, and after a few minutes, a few hours, a few days, weeks, it doesn't matter which time frame, the price was higher at the starting point. This is an example for an uptrend. In an uptrend, the price isn't going to go up steadily. It is always going to retrace no matter what. Which means in a real chart, the price movement in an uptrend is probably going to look something like this. On the other hand, a downtrend is where a lot of bearish, of negative, of red candles are forming. And not only a lot of them are forming, the bearish candles should be bigger than the green candles that formed in a downtrend. Like I explained in the last example for an uptrend, a downtrend is also not going down steadily. It is always going to look like this in the market. There is always gonna be a up and down movement in the market. These little up movements in a downtrend, in a bearish market, are called retraces. On the other hand, these little down movements in a uptrend, in a bullish market, are called retraces. Which means the market is going to fix itself and want to reach the people that want to trade this currency pair at this price, so they are going to buy this currency pair or sell this currency pair at this price. So let me show you a real life example when you are on TradingView that looks like an uptrend. So this is a perfect example for looking at an uptrend. Here you can see the starting point of the uptrend was down here, and the finishing point of this uptrend was up here. And you can see the market is moving upwards but it's always going to go retrace to a lower point. So in an uptrend, we have higher highs, higher lows. This was the last low. This is the new low. So we formed a higher high, then a higher low, then a higher high, then a higher low, a higher high, higher low, higher high, higher low, higher high. That is the move of an uptrend or bullish market. Now let me show you a real life example when you're watching TradingView of what is a downtrend. So here in this example you can see this is where the move of the trend started. So this was a higher high in the last example in the past. So now the market moved and formed a lower low. After that, it formed a lower high than the previous high. Then it formed a new lower low than the last lower low. Then it formed a new lower high than the last lower high. Then it formed a new lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. So this is basically all that you need if you're looking at charts to understand what is going on and what are you looking at. Now that you understood what is going on and what are you looking at, we can go over a few examples of strategies that you can use in the market to predict whether the market is going to go up or is going to go down. And in the Forex market, or basically in any market, if you trade this market, you're always betting on if the price is going to go up or if the price is going to go down. If you don't make any analysis beforehand, the price is always in a 50-50 chance to go up or down. And that is not going to bring you anywhere if you want to trade the market. You should have a basic understanding of what is going on in the market and where the market is probably going to go, so you can place a bet on buying or selling this currency pair or this stock if you want to make money. So now that you know that the market can be in an uptrend or downtrend, there is a third phase in which the market can be, and this is consolidation. Basically, consolidation means when the market is moving sideways. That means there is no real uptrend or downtrend, and sideways consolidation is going to look like this. So in this market, in this consolidation phase, there was a high and a low. There was a higher high and there was a lower low. Then there was a lower high and a higher low. Then a higher high, and then the same low as before. It doesn't matter. So this could potentially be a downtrend. This could potentially be an uptrend. You don't really know, because the market is not really signaling on whether it wants to go up or down. So the market is moving up and down, but basically in the same range between up and down, sideways. So now let's say the market was or is in a consolidation phase, which means market is going like this. And at some point, the market has to decide whether it wants to go in an uptrend or downtrend, which means the market is going to break out of this consolidation phase, whether to the up or whether to the downside. And after that, you can define the market situation new, whether the market is in a uptrend or is in a downtrend. So you can make your market analysis and strategy new. So now that you can understand how the market is moving and how you can identify whether the market is going up or down and what candles are and how candles come in these trends, let's go over a strategy that you could use if you started out in trading and want to make your first bucks in trading. This strategy is called supply and demand. It's relatively beginner friendly, and if you just watch me closely what I am doing on these charts, you can do it too. And after that, you can implement it in your daily routine to watch charts and mark out supply and demand zones. If you want to know what supply and demand zones in depth are, I made a video about that in the past. You can watch that video and come back to me later. But for simplification, I'm going to make this short. So I'm going to behave right now like you have a simple understanding of the market and of supply and demand zones. But let's go over this strategy one more time. Let me show you some examples how you can spot supply and demand zones in the market and how to trade them, so that you can enter trades in your demo account, or maybe after a few weeks or months you can trade this with your own real money. So basically, for supply and demand zones, you're looking for a big move in the market where the guys with a lot of money are entering or exiting. So buying or selling this currency or this stock market. The first example I'm going to show you, you're seeing 1, 2, 3, 4 green candles, green bullish candles in a row. And these are pretty big. The price range is kind of huge on these ones. So the probability of the guys in the market that spend a lot of money on the market, that are the guys that made these moves and made these candles so huge. So you're going to look out for the last red candle before this green huge bullish move started. In this example, this right here is the last red candle before the green bullish move started. So I'm going to mark out the highest high from this candle, this one right here, to the lowest low from the candle. I'm expanding this zone to the right. And when you're looking at a market in a uptrend, the zone from this last red candle is going to be our new demand zone. So how are you going to trade it? For a simplification, when the market broke out of this demand zone, there is always a high probability for the market to retrace to this price range before the big move started, because there will be a lot of other guys that want to go in the market. Maybe you want to go in a buying position in this market. So the probability of the market going to retrace to this zone is fairly high. And as you can see in this scenario, the price broke out of this zone, came back down, came back with a retrace, tested this zone, and after that the price shot up. It came back down once again to this zone and shot back up again. And these points in the market could potentially be the place where you're going to place your trade. So in this scenario, I waited for the price to come back down to this zone. Then I placed my trade in this zone, moved my stop loss below my demand zone that I drew, and took my take profits somewhere around here. You can draw your take profits at the last supply zone or the last demand zone that formed, but eventually you will get a feeling how much the market is going to move up or down after this breakout. And if you exited your trade after this move up this is also fine. You also made money. And this example is perfect because the price retraced to this demand zone a second time. So when it hit this demand zone, you could have placed a new trade. Stop loss below your demand zone, take profits somewhere around here, and as you can see, market has hit your take profits. A little smaller example, but also effective, is this example right here. As you can see, these moves aren't really that big, but it could also potentially be a new demand zone because the market is moving up. As you can see, if we draw out our demand zone from the last red candle that formed, this is a demand zone. Price broke out of this demand zone, came back to retest it, and broke out again. So this is a point where you could have placed a trade to the upside. Now that we are in a uptrend and the market was moving higher, this last candle could also potentially be a new demand zone. And as you can see, the market broke out of this demand zone again and came back to retest this demand zone. So you could have placed a new trade around here. And then again, market moved upwards, it came back down. After that, the market moved up again, so this could potentially be also a new demand zone. But as you can see, the price didn't come back into this demand zone. So this is no point where you should place a trade in or with this trading strategy. Now let's go over some bearish examples. So the market was in a downtrend. We are looking for supply zones. So in this example, you can see market was moving down. This is a big red candle where the market buyers or market sellers, the guys with the big money, with a lot of money that can move the market, they probably traded this candle to go that low. So for a supply zone, you're searching for the last green candle that formed before the big move happened. So in this scenario, this is the last green candle before the big move down. So we mark it out from the high to the low. This is our new supply zone. And as you can see, it took a while, but the market moved out, the market broke out of this supply zone, came back to retest it, maybe make it a bit more clearer. Market moved down, came back to retest it, and broke to the downside again. And that is the point where you should go in your trade. Place your stop loss above your supply zone, move your take profits somewhere around here or maybe here. And as you can see, the market moved downwards from there. So you could have made profits. Another short-term example for a bullish downtrend and for the supply zones is right here. As you can see, there are big red candles that move the market to the downside. So before the move happened, you're searching for the last green candle this time that formed in the market, and you're gonna mark it from the high to the low. Expand it to the right. That is our new supply zone. And as you can see, market broke this supply zone, came back to retest it, and the people still wanted to sell this currency pair, and it broke down again, came back to retest it again, and broke to the downside again. So both of these times, this could have potentially been a trade of yours, where you can go in the market where the price hit your supply zone and take your profits somewhere around here. This could have made you money. So now that you hopefully understand supply and demand zones a bit better now, I want you to go in your charts in TradingView that I showed you earlier and mark out 5 of these supply and demand zones. You can see this like a little homework for you, because practice is key here. You have to identify the correct supply and demand zones in the market. And when you're identifying the correct zones, you can make a lot of money with it in your demo account or in real life trading after that. Now that you know where to make your market analysis, TradingView, when to enter or exiting trades, you want to execute these trades and make money on paper or money in real life. The most important thing is entries, stop loss, and take profits. So I showed you this example earlier where you could have entered the market and bought a position. So you are betting on the stock market to go up. So you are going long. These are the 2 points where you could have entered the market. The most important thing for that is risk management, which means you don't want to risk all your money on a trade. The normal risk management for every trader is around 1 to 3% of your account size, which means if you only have $100 in your account, you should only trade $1 to $3 per trade, and $3 is high. You should risk around $1 to $2 per trade. And there are a lot of risk management calculators online. Just search for them, give them your account balance, give them the risk to reward ratio that you want to achieve with your trade. For example, the risk to reward is 3. So the profit that we are going to take with this trade is 3 times higher than the loss if we're losing this trade. So if we lose this trade, for example, we're losing $1. If we are winning this trade, we are winning $3. Like this example. If we are losing this trade, we are losing $1. If we win this trade, and we could have won that, we are winning $5.25. And the same goes for when you have $1,000 or $10,000 in your bank account or in your demo account and you want to trade with them. So risk management should be something like this. If you have $10,000 in your balance account to trade with, which I wouldn't recommend as a beginner trader, maybe start with a demo account or only a few hundred or maximum $100 at the beginning. Because remember, the money that you are using for trading shouldn't be the money that you wanted to buy groceries with, or pay your mortgage down, or pay your rent. The money that you trade with should only be the money that you have no use for currently. So it may be $100. But for the 10,000 example, you could have made $300. Maybe you lost 100. You could have made $525. Maybe you lost 100. And if you place your trades right and place your entries right, place your stop losses right, that means when you place a trade with a risk to reward ratio of 3 all the time, you have to lose 3 trades in a row to even out one winning trade. So after you calculated your risk management, and they are almost always going to ask for pips. Pips is this number right here. The movement in the market is represented by pips, or how many pips the market has been going up or down. For example, your stop loss is 11.2 pips below your entry, and your take profit is 33.6 pips above your entry. So now that you calculated on how much you want to trade with or how much money you are betting on this trade, you should go to MetaTrader or any broker that you want. For example, I'm also trading with Interactive Brokers. Link is in the description below if you want to check out these guys. Really reliable, no really fees. This isn't even a sponsor, I just really like them. But probably most of you are going to use MetaTrader because it's simpler and all your trading gurus are always using that. So go over to MetaTrader, and if you want to buy or sell your position now, so you made it clear you want to get in a trade because this is the time on the market now. If the market chart maybe looks like this, so you know I want to go in the market now and bet that the market is going up. You're going over to MetaTrader, then you set your lot size, depends on what account balance you're using for your trades. Click buy. And MetaTrader is making it really simple for you. You can drag and drop your stop loss and take profits like that. So you marked out where your stop loss is going to be. Drag to modify. So I bought this stock. So my stop loss is maybe going to be around here. Or I have an account balance, like I showed you the demo account, from $100,000. So 1% of my account would be $1,000. So I am setting my stop loss around $1,000. See on the left side. And I am going to take my profits 3 times the ratio of my stop loss, so $3,000, because I was betting on the market price to go up. So if the market now hits my take profit, it is going to leave the trade, and after that I'm going to be in profit with $3,000. If I lose my trade, I'm going to be down $1,000. So that is how you make your market analysis, and go over to your broker, set your trades depending on your account balance, set your stop loss and your take profits. And please don't move your stop loss. That is a mistake a lot of beginner traders are making, because you're thinking, yeah, the price is going down, I thought the market is going to go up, but now in the next 5 minutes it's probably going to hit my stop loss. I should move it maybe a bit down, maybe to $2,000 or something like that. You shouldn't do that. If your strategy that you marked out in TradingView isn't working on this trade, that's completely normal. That happens to every trader every time. No strategy is going to win 100%. So if this market is going to hit your stop loss, just take the loss and leave the trade and look for the next opportunity that you can enter the market. So keep in mind, trading is for everyone, and everyone that tells you otherwise is wrong. Everyone can trade if they follow a strategy, a simple step-by-step plan on how you can find the right place in the market where you can enter and exit trades. And of course, be on point with your risk management. You don't need a financial degree on trading. You don't need thousands of dollars to make $100 or $1,000 in the market. You don't need 10 monitors watching and monitoring every chart that you know in existence. And you don't need 10 hours a day watching charts. You can make this a daily routine. Maybe when you get up in the morning, watch the charts. Is there maybe a point where you can enter the market after you've drawn your lines, your support and resistance, your supply and demand zones? Is there a point where you can enter the market? If not, maybe leave to work, go home, and then watch the charts again, and maybe you can find a point to enter the markets. You just have to have a strategy in mind, keep your discipline and risk management good, keep a good mindset. Every trader is going to lose, and a lot of traders are losing maybe 3, 4, 5 times in a row, even if their strategy is on point, but maybe the next 6, 7, 8 trades are winning. So just for starters, watch the charts 1 hour a day, mark out your strategy where you want to enter the market, and wait for the right price movement to execute your trades. And if you still have a lot of questions in mind, feel free to leave a comment if you want to know more about a specific time or a specific part of the video, and I'm going to do my best to answer you properly. And last but not least, you have to journal your trades. You have to know when you entered the market and when you made profits and when you took a loss. So you know maybe you have to make some tweaks to your strategy to win more consistently. So just open an Excel sheet and journal your trades. Maybe set the dates, then mark out if you won or lost your trade. Write down what was your risk to reward ratio. Write down how much profit you made or how much money you lost. And maybe finally keep some space to improvements at the end, so you can tweak your strategy a little bit around if you want to win more consistently. And if you are a consistently winning trader over a few weeks or months, you can try out prop firms. After you finished your demo account and you are in profits after 2 to 3 months maybe, you can try out prop firms where you can buy a challenge maybe for $100 or $200 and trade with real money. But the plan should be the same. Focus on your mental, set your stop loss and take profits at the right point where you marked it out in your strategy, and don't move them. And if you won the challenge, congratulations. You got funded and can finally trade with real money. But that should be a long way to go. You first have to be consistent as a trader, consistently winning over the long run. If you want to know how to get funded, if you are already a consistently winning trader, watch my other videos on that. But that should be it for this video. Just remember, stay focused, stay disciplined with your mental and your strategy. Work it out over a few weeks or months. Perfect your strategy, and after that you can become a consistently winning trader and make your living of that. So I hope I helped you with this video to get started in trading. And if you want to know more about trading or what other strategies I used in my trading career, maybe watch my other videos. And if this video helped you to get your first foot in trading, consider giving it a thumbs up or even subscribing to my channel. It would help me a lot. But for now, I'm out. So then, see you next time.